So this is the beginning of a fun day, and it is a particular pleasure to start with Marc Andreessen, who is one of my personal heroes and our cover boy this month. Marc and I have first met him 18 years ago when he was a baby-faced recent graduate of the University of Illinois, and had just started Netscape, had co-invented the modern browser, and one of the most striking things in this first meeting with him, which was really just to understand the whole. We were trying to figure out the basic web. Was that although Marc was interested in the technology and the software and all that, he immediately was talking about global economics, about the effect on innovation, on social impact, and all that. And it was just sort of it was so unexpected. That this, I think at the time you were 22, I think, this 22-year-old, software engineer right out of school was thinking about the hugest impact of the web. And that, I think, set the tone for Marc's career. There was, one of the first to think of the browser as an operating system, which we now think of Chrome OS and beyond. One of the first to consider the impact of the cloud, to use the term loud cloud, which became Opsware. One of the first to get into social. And then most recently, after he started the venture capital firm, the theory of software will eat the world, which we'll talk more about, which I think is absolutely mind-blowing and probably the right way to think about software. That sort of combination of feet-on-the-ground technology and almost sort of a philosopher king of the thought about the broad implications is why Marc is here and here. So welcome.
Thanks.
I wanted to start with. We have a bunch of things to talk about. And by the way, questions you can tweet it to us, hashtag WiredBizCon. So I'll be seeing that. We'll go about 20 minutes here and then 10 minutes for questions both online and in the audience. But let's just start with the whole notion of, we'll get to the sort of technology trends, but let's start to the whole notion of the financial markets at the moment. The bubble, the notion that we're in a bubble. Now, Marc's on several boards including Facebook, so we can't talk about Facebook per se, but as a venture capitalist, the notion, this question must come up all the time. Are we in the bubble? And when you see Instagram selling for $1 billion with no revenues, one has to ask, how do these valuations come about, and how do you justify them? So I know you can't talk about that in particular, but as a VC, when you look at valuations right now, how do you do the math and come up with something you can justify?
Sure. So I should start by saying, hashtag conflict of interest. I'm invested in a lot of these companies, so that's obviously to my benefit if we're not in a bubble. But on the other hand, I'm investing because I don't think we're in a bubble. So maybe the various conflicts balance themselves out. So as you said, I can't talk about Facebook. I can't talk about Instagram. So I'll leave that to other people. But let's pose a hypothetical case of, let's say Google decides to buy Vidi. Vidi, this new social video. Some people are saying Instagram for video. So social video companies, Vidi, SocialCam, a couple other companies that have been growing very quickly the last few weeks on sort of mobile social video. Or even to make it even better for me, let's say it's Moogle buying Diddy. Just to take it completely into the realm of the hypothetical. So big established technology franchise company like Google that decides it wants to own, kind of the hot new sort of social viral thing. I think there's a couple things in terms of how these things get valued that I think makes a lot of sense for the acquirer in the case of, in the hypothetical case of Google, if Google were to do that. One is they're going to be looking not so much at how Vidi monetizes, but how Google would be able to monetize Vidi, which, by the way, is the exact logic by which Google bought YouTube, which is one of the great deals of all time. And so, it's not so much the actual money that the startup is making today, it's what the large company can actually do once they have it in terms of monetization. And large companies always have very detailed internal models. I mean, I see this on the other boards I'm on when we do acquisitions. You always have very complex, detailed models based on your existing business that show what you're going to be able to do with the acquired company. Yahoo had a very similar model when they went to buy Facebook for $1 billion 6 or 7 years ago, which in retrospect would have been a very good deal had Yahoo been able to get it closed. So that's one, is what can the acquirer do with it? The other is, to the extent that the acquirer, to the extent, for example, that somebody like Google thinks that social is a problem and something that needs to be solved and is a potential threat to the core business, then what percentage of the acquirer's market cap might they be willing to spend to buy the insurance policy, to basically buy the insurgent? Sort of like, it's a bad metaphor, but when the U.S. goes into Afghanistan, there's a certain amount of money we'll pay to buy off the Taliban. Right. And when a large company buys a startup, it's often kind of the same thing of like, there's a certain amount of money we'll pay in order to make sure that we capture what's about to happen as opposed to having it happen to us. And so again, there's a strategic value to these things in a lot of cases that drives what happens. And I would say, the strategic value, it's always a hypothetical at the time, but then you look at lots of these examples, of companies that could have bought, the companies that ultimately disrupted them and didn't do it. And so, you've got, and then you see these companies like whether it's Kodak or Borders or whatever that get eaten by software and go down in flames. Yeah. And it's like, well, if they could travel back in time and if they could spend 1% or 10% of their market cap to basically buy the insurgents before things got too far, that probably would have been a good idea.
Do you have some examples that come to mind of companies that should have bought but didn't?
Well, I mean, there's a whole bunch of examples. I mean, probably the one in the market right now that's most dramatic to watch, well, the two that are most dramatic to watch right now are Nokia and RIM, right? Both of which, in retrospect, about 5 years ago, needed a modern operating system and didn't have one and didn't buy one. And if they had, in either of those cases, things might have turned out very differently. So
who could they have bought it?
Oh, they could have. It was a whole. I mean, they could have bought Palm. They could have bought. At one point, they could have bought. I mean, Google bought Android. Right. At a point when they could have bought Android. And there have been lots of other people running around trying to do, smartphone OSs, back then. So there are always new teams of people trying to do this. Today, it's probably too late, but at the time, it probably would have been a good idea. Sure. And at the time, they probably would have gotten criticized for overpaying because at the time, it would have said, well, the smartphone market is tiny. Why would you ever spend any money on this? Well, because, as they say, shift happens. Well,
so exactly. So you described a situation where you're buying complex technology. You need complex technology. You've failed to develop the complex technology yourself, so you buy the complex technology. Whereas in the previous instances, presumably the Instagrams or the apps that were the equivalents, the technology is not terribly complex. What you're buying is in some sense the user base. Is that wrong?
Yeah. So I disagree with it. It depends what you mean by technology. So to be Clintonian for a second, I think people really underestimate the technology behind some of these things, and especially for some reason the communications advances tend to get criticized for not being very sort of technology heavy, and I think it's very unfair. You always say, well, actually, my friend Peter Thiel and I argue about this all the time. He always says, well, so Twitter doesn't count as technological innovation, compared to going to the moon. And my argument is, I'd much rather have Twitter than the moon landing. The moon landing, 20 guys were able to go to the moon, and it turned out there was nothing there. Twitter, you've got 5 billion people who are going to be able to communicate with each other in a much better way. I think from an importance standpoint, these communications things are actually very important. Number two, the technology actually turns out to be complex. And building a system that's able to handle millions and ultimately billions of people communicating in real time, being able to wire into the basic technology what the patterns of user behavior are going to be so the whole thing kind of holds together and people behave the right way. Scaling a system like that and then adding all the capabilities that end up surrounding a system like that, the APIs, the platform capabilities and so forth, and getting it wired into thousands of applications. These tend to be very, very big, deep technology efforts. Analogous in a lot of ways to what AT&T did once upon a time when they built the telephone system. So it's the same kind of thing. And so I think there's a lot more technology. The other thing I'd say is people get distracted. There's a lot of criticism right now. We see this with companies, we invest in companies, Foursquare, or even Facebook and Twitter themselves, or Instagram or Video or SocialCam, these companies where they say, well, it's just an app, right? It's just an app, and like there's 100,000 apps in the App Store, and so what can any one app be worth? And it's like, well, an individual app like itself may not be worth much, but the app augmented by the back end, right, by all of the capabilities and the network and all of these other things that we're talking about, what the user actually sees for a lot of the really important technologies, what the user really sees is a very small fraction of the actual value. A lot of the value is embedded in the back end systems. and in the team that's been able to wire that whole thing together. And that's the case for a lot of these companies as well.
So your point is that although the engineers may say we could build rather than buy, in fact, that's harder than they think.
It's much, yeah. So build versus buy is typically, especially at big companies, is typically much harder to build internally than people think. And well, so the other thing, right, the other thing that big companies criticize for doing acquisitions, but a big part of what big companies are able to do through acquisitions, especially in our industry, is they're able to basically let the Darwinian free market figure out what new things are going to work and what things aren't, right? So it's always criticism sort of in retrospect saying, well, such and such big company should have done that thing internally.
Right.
Well, it's like they wouldn't have known up front. Nobody knew that that thing was the thing that was going to work. It's that thing plus the 1,000 other things that people tried that failed, right? And so there's no big company that's going to try all the experiments that the free market's going to be able to do. And a big part of what venture capital does is basically funds all those experiments. And then I think big companies get to take advantage of the Darwinian startup environment to basically cherry pick the best of the bunch in a lot of cases and be able to fold them in.
So you don't believe we're in a bubble? You believe these valuations are justified?
Well, I think number one, I think objectively it's hard to say we're in a bubble in technology generally when technology stocks are trading at a 30-year low relative to industrials, right? So we're 15 years, we're now 15 years of flat stock market returns overall, and we're at a 30-year low of tech stocks multiples relative to industrials. So if we're in a bubble, it's the weirdest bubble I've ever seen where everybody hates everything. Right. Like everybody's just in like a foul mood, and you even see this with these new tech companies. These new tech companies in the last year, a bunch of internet companies have gone public, and if you check their stocks lately, like they just they've generally like hard nosed straight into the ground. Like that's a weird bubble. That's not the kind
those
of
are the public markets, and yet more and more transactions are happening in the private markets.
So then you have this very interesting phenomenon where you have these new businesses in the private markets, some of which are billion-dollar-plus revenue companies, some of which have been created literally in 2 or 3 years, some of which don't have revenue yet, but people think they're going to have a lot of revenue. And then you've got this very interesting phenomenon of you've got public market investors like mutual funds and hedge funds that are crossing over, basically buying these stakes in these late-stage companies, which is where a lot of the bubble it's where a lot of the valuations come from that causes people to say bubble. Well, so the problem is, you look at it from the perspective of a public market investor, like I say, 15 years of flat stock market returns, which is really kind of extraordinary if you think about it. Like 15 years of just like basically nothing in the stock market, number one. Number two, over that time period, it's gotten much harder for companies to go public because of all the new regulations. The result of that has been that if you're correcting for GDP growth, the number of public companies in the market today, in the stock market today, the number of public companies is half of what it was 10 years ago. Right, and so what's happening is the term is de-equitizing, so the public stock market is de-equitizing. So more and more of the actual interesting economic activity is happening on the private side. Now, if these companies, years ago, all these private companies would long since have been public. I mean, when I came up, you took these companies public, 16 months after you start them. And
I think you had both the first and the second fastest IPO and the second fastest IPO.
Yeah, but we took Netscape public as an example on a $20 million revenue quarter, which at the time was like a decent size to go. These days, you would never do that. It's just it's way too hard and expensive, and there's all kinds of issues involved in doing that. And so what's happened is basically the opportunities for if you're a public investor and you want to invest in growth, the opportunities to invest in growth on the public side are just vanishing. They're just not there, and so they've shifted to the private side. So, we'll see what happens. Things like the Jobs Act are going to, are basically a counter trend, and so hopefully, if we start to get regulatory reform, maybe we'll start to get more IPOs. But right now, if you have to go in the public market and invest in growth, it's actually very hard to find things to invest in. And so I think that's we'll see. I don't think that indicates bubble. I just think that indicates there's just strangeness in the way that the markets are behaving. We're talking about a small number of companies. We're talking about a small number of investors. To me, none of that says bubble. That it just is what it is.
So as those valuations go up, does your job as a VC get harder or easier? I mean, obviously your exits get better, but the valuations, the initial valuations, are presumably there's an expectation that they'll be higher as well.
Well, we'll see if the exits get better. I mean, it's all theory until they go public or get sold. Until then, it's all just numbers on a piece of paper. Generally easy. I mean, generally, the more late-stage capital that's available, the better life is for VCs, and these companies can get funded later on. Generally, that's good. On average, it's good. But it'd be better. It'd be better if we had a well-functioning public market like we used to.
Yeah,
that would be an improvement.
You mentioned the Jobs Act, which is the Obama administration's initiative to encourage crowdfunding and sort of smaller ability for smaller investors to get involved. We're going to be talking to Kickstarter later on today, and this is it's not equity investment, but it is an opportunity for people to essentially fund small companies by pre-ordering products in a sense. When you look at Kickstarter in particular, do you see this as competition for venture capital, or in some sense, maybe collaboration with venture capital? I mean, how does that fit into your ecosystem?
Well, as of right now, Kickstarter is very interesting. As of right now, Kickstarter can neither be used for nonprofit projects or for-profit projects. It's actually by policy. It's actually very interesting. It only gets used for things that are somewhere in the middle. And I wasn't sure for a long time whether there was anything in the middle. But actually, so technically what Kickstarter gets used for is sort of artistic projects, creative projects.
Well, I mean, the poster child at the moment is Pebble, the smartwatch that just raised, or is still raising money, but above $7 million. Now, that's a for-profit entity.
It is becoming a they were attempting to raise money for a company. And they were, my understanding of the story is they were having a hard time raising money for a company. So they decided to basically see if the community wanted to fund it.
Right.
But I'm just saying, like under Kickstarter's policy, that qualifies as a creative project, not as a for-profit project. Now, to your point, though, it's pushing the envelope. I mean, obviously, in my mind, obviously Kickstarter or something like Kickstarter should exist for for-profit projects, something like it should exist for nonprofit projects. Clearly, there's a tremendous amount of pent-up user demand, consumer demand to be able to participate in, basically voting with one's dollars, with one's wallet, for things that one wants to see exist. I think that's a great concept. So the answer to the question is the big thing Kickstarter is doing right now in a case like Pebble is it's signaling demand. Like it's signaling real tangible demand before the company even gets funded. Right, which is something that has not been. I mean, in the old days, the precedent for this in the old days was, if I wrote books for a living and I wanted to, write a new book, I didn't know if there was demand for it. Right, I'd put a classified ad, in the back of the New Yorker or something, or the back of Wired, and I'd say, if you want this book, send, $19.95 plus shipping and handling to such and such an address. And if enough people sent checks, I would write the book. Right.
Very quickly.
Yeah, exactly, as quickly as possible. Some of our entrepreneurs experiment that way on Google Ads, right? You buy Google Ads for a product that doesn't exist yet, and you see if people click through. So Kickstarter is like the next advance on that front. It's sort of predicting demand by actually proving that there's demand, as opposed to just hypothesizing about it. So I think it's a great thing.
So so when you look at a company that has a successful Kickstarter, project, it's de-risked it to some degree for you, but it's also diminished their need for you, and presumably increased their sense of their own valuation.
Yeah, well, so this is sort of the nature of venture capital is you're going to, if you're a venture capital investor and you're optimizing for valuation, you definitely want to invest in these things before they prove that they have demand. On the other hand, there are a lot of things, especially the really disruptive, really new ideas that, are hard to think about ahead of time. A lot of the times those companies have trouble raising money, and when they have trouble raising money, it's because they can't prove the demand. So I think that's a net plus.
So if a Pebble or something like that comes to you and they say, look, we had this incredible run, but we now need to ramp up our production processes by some far faster than we realized, and we're not going to do it simply on pre-orders alone. Yeah. That would be an appealing prospect.
Oh, absolutely, yeah, very much so.
Now, which actually takes me to the notion of internet meets hardware. I mean, so Pebble is, let's say, an example of the Internet of Things, which is to say increasingly these devices on our bodies and around our houses that have intelligence, sensors, wireless, et cetera, are connected to the internet in various ways. And this takes me a little bit to your thesis of software eats everything. And this is this notion that more and more what were traditionally hardware functions become software functions. There's an app for that. They kind of get subsumed into general purpose computing platforms. So on one hand, we see sort of a spread of single purpose hardware devices that are connected to the internet. And the other, we see the app notion of all those devices being sucked into a singular device, like a phone or an iPad. Do you see these being in competition, or is this all part of your thesis?
Well, I think the big thing that's happening is a much larger percentage of the IP and the value add in a consumer electronics device, whatever that is, special purpose or general purpose. The percentage of IP or value add or kind of economic value or innovation or technology or whatever you want to call it in that thing, the percentage of that's software is rising very quickly. My favorite example of this is the iPhone itself. iPhone itself is interesting. So people say, well, iPhone is a great example of how manufacturing has moved outside the U.S. iPhone is built in China. And in fact, China, people talk about the trade deficit all the time, right? So China gets full credit in their trade numbers for the production of the iPhone and the process of building it and shipping it to the U.S. Right? In practice, though, right? This was a little line designed in California. In practice, the vast majority of the IP in the iPhone, right, which is to say all of the actual technology innovation as well as all the actual dollars of profit that result, of course, are created by companies not in China, created by Apple and created by the ecosystem of app developers, which for the most part are not in China, created by the chip designers, companies like Broadcom and Qualcomm and others that are US-based companies. So the vast majority of the actual IP and economic value of the iPhone is not attributable to China. It's attributable to the United States. It's actually, and this all warps all the trade numbers. This causes us to think we have a much bigger trade deficit than we do because China gets full credit for that in their trade numbers, whereas they shouldn't. They should really only get credit for the small percentage of the value that is attributable to, to actually putting the thing together. And so that's kind of a case study, I think, of what's happening across consumer electronics. And this is a big part of the thesis that I have, which is I think that a lot of the consumer electronics industry is actually going to move back to the United States now. If not in the manufacturing part, then certainly in all the design and software and network services and all of the sort of actual value and all the interesting capabilities that get built around it. Right? Not completely, but there's a big counter trend happening in that direction.
And so what does that do to the American economy?
Oh, it's tremendously positive. It's a very, very positive thing, because these are very big markets and these are very big opportunities for these companies. But we have a whole ecosystem in the United States of chip makers and people who make all the wireless, the radios, and people who make all the software and the apps and everything and all the network services. Facebook and Google and all these companies are in the U.S. And they now get to express what they do through more and more different kinds of hardware. So I think it's very exciting. And then I think you get this sort of, the great debate then happens of like, is this special purpose hardware or general purpose hardware? I think that's just a timing and staging issue. And I think that, for a long time, it took a long time for a lot of things to collapse into the smartphone, and now they have. There's this new generation. I'm wearing my favorite, the Jawbones Up bracelet.
I'm wearing the Nike Fuel.
The Nike, yeah. We'll battle.
Yeah.
I think right now these are these sort of functional appliances or sort of fixed function appliances. I think these are going to become general purpose computing platforms.
Yeah.
And then I think there's going to be a variety of new kinds of general purpose computing platforms. These things are going to have app stores and they're going to have all kinds of downloadable functionality.
Well, we do have Nike on actually later in the day, and just watching their own company. I mean, they originally started with these little sensors in your shoes, and then increasingly, and then watches with GPS. Increasingly, these became smartphone functions. But then you realize they didn't necessarily want to carry the phone throughout the life and throughout your day. And so some of them, the bits that need to be on your body are on your body, and the bits that can be on the phone are on the phone. And I agree, we get this sort of balance between the two. The question you must get all the time, both as a VC and a technology leader, is what's the next big thing? And when you look in particular at your investing philosophy and where you're looking for the next big ideas, can you describe any sectors or a thesis that you follow?
Well, the main thing we try to do is to not have any theses. So the main thing we try to do is to be as opportunistic as possible. So my experience is when the next Mark Zuckerberg walks in the room and tells you he's going to build Facebook, the really radical ideas are out of left field. Like it's actually really funny. They're either ideas that nobody's thought of before, in which case you just don't know how to wrap your head around them at all. Or like in the case actually of both Facebook and Google, they're ideas that actually 35 other companies tried before and didn't succeed on. And then you get the kid who says, but I'm going to be the one who makes it work. And then it turns out they're right. And so it's very easy to be too early. It's very easy to be too late. It's very early to not take these things seriously when they first appear. And so I find having too many theories up front just like rules out all the disruption. Because if you can put a framework around it, then it's probably not disruptive. At least at the time that a venture capitalist is supposed to be saying it. So we try really hard to not basically smoke our own exhaust, on that kind of thing. That said, we can't help ourselves. We have 18,000 theories, and we spend all day talking about this stuff. So, I'll float a couple. One is, the thing that's underhyped. John Doerr used to say the internet is underhyped. The thing that's underhyped, these days, the smartphone revolution is underhyped. We have never lived through an opportunity in our industry to put a computer in the pocket of 5 billion people. Yeah. There's never been anything even remotely close to it. And this is why I get all fired up on all these new communication technologies and all these new social networks and everything. The opportunity to wire the planet. I mean, PCs only ever got to some number of hundreds of millions of people. The smartphone is going to take, more people now have mobile phones and have access to running water, right? And those things are, all phones are going to be smartphones. And so everybody's going to have a general purpose computer in their pocket. Everybody's going to have full access to the internet. Everybody's going to have full access to search engines and social networks and online education and all these things. And it's so easy to underestimate this. We've never had anything like that before in the history of the planet. And so that has to be the really, really big one that is sort of the story of our time.
Can you describe one of those left field opportunities that came in your office recently that you invested in?
Oh, well, okay, my favorite one. So my favorite one, Lytro, is our new camera company. So I can only talk about the ones that have launched. We got a bunch that haven't launched yet, but Lytro launched recently. So Lytro, so we backed a new camera company, and if you had asked me when we started our venture capital firm in 2009, are we going to back a new camera company, right? Well, Kodak is in the process of going out of business. I would have said you're out of your mind. Like, that's a crazy idea. And this guy walks in, Ren, walks in, and he spent 15 years at Stanford in the computer science program building this new technology called light field photography, right, which basically is the first fundamental advance of photography since the invention of photography, right? It's a much bigger advance than digital, the switch to analog to digital. And so the concept of light field photography is he captures all the three-dimensional light rays in a scene as opposed to just the two-dimensional rays that happen to hit the camera lens. And so you take one photo and then you capture all possible 2D photos that could be rendered of that scene, and you can re-render it at any point you want. So you can refocus the image after the fact, you can relight the image after the fact, you can change the perspective. There's all these just magical things you can do. And it's really this sort of combination of photography and computer graphics, kind of bringing together kind of what's happened in Hollywood over the last 20 years, bringing together what happens in the real world with what you can do on computers. And at Stanford, they built one of these things, and it was a wall. It was literally a wall of cameras. It was like a 15 by 15 foot wall of cameras. Cost millions of dollars to build this thing. He figured out how to put the thing on a chip, right? Story of our industry. And then he went out and partnered with the former chief technology officer and co-founder of Silicon Graphics, which of course was the leading company in 3D graphics 20 years ago that created kind of Jurassic Park and then all these great 3D graphics we see all around us today. And so they've just built absolutely breakthrough, photography. They just shipped their first camera, and it's just absolutely marvelous. The current one is fairly low resolution, so people are still trying to figure out what to do with it. The next version they ship is going to be super high resolution, and you're going to be able to do basically anything you can do with a conventional camera. And and we'll see. I think it's going to do very well. I can tell you, we never would have predicted we'd back a camera company.
Yeah.
I mean, we pick up the newspaper and Kodak goes bankrupt, and it's like you don't know whether to laugh or cry, but here we are.
Let me ask one more question before we turn to the questions from the audience and Twitter. So you just described that the smartphone revolution has been underhyped, and that there's going to be a supercomputer in the pocket, and all phones are going to be smartphones, et cetera. Typically smartphones, the one thing we know is that the phones advance faster than the networks. So the gating factor seems to be the carriers and all that, especially outside of developed world. That seems to be an argument for the app future. And yet, and now with cards on the table, my argument that there's a risk of the open web going the way of the closed gardens of apps and the iTunes world, the Apple world, the Facebook world, et cetera, in part because consumers want the ease of use of this kind of controlled experience, running counter to everything that you invented with the original web. How do you square the two? The notion that A, smartphones are going to win, and B, the belief or hope that the open web is going to win.
Is this going to be another cover?
I guess I'm asking.
The web is dead, part two.
Or is it going to be that HTML5 rises and solves this problem and keeps open and utility? And how's this going to work out?
Yeah, so I think you nailed the app phenomenon. But so yes, the limiter is the networks. I mean, the good news of the networks is Wi-Fi is kind of the outlet, and so actually it's really funny. If you talk to the carriers 2 or 3 years ago, they would have said Wi-Fi is a big competitor, and they talk to them today, and they're like, Wi-Fi is the great savior.
Right.
Like they're all hoping for massive Wi-Fi proliferation because the more Wi-Fi there are in offices and homes, the less the 3G, 4G networks get melt down. So it's not an absolute. It's not like we're facing absolute network meltdown, although there are challenges. But yeah, so apps are clearly an example. I mean, lots of people have lots of reasons for doing apps. So one of the big reasons is because you get much more logic running locally on the machine. So you're able to, in theory, cut the bandwidth use. It's great. It's not. I don't think it's slowing down the web at all. I don't think it's slowing down the web at all. I don't think it's slowing down the mobile web at all. The browsers on modern smartphones are state of the art. And if they weren't state of the art, I'm not sure anybody would want those phones. So for all of everything Apple and Google are doing to foster an app ecosystem, the Safari and Chrome, the Android browser are top-notch browsers. There's actually quite a few third-party browsers now on mobile phones that are doing very well. And I think, look, users like apps, users like games, users love the web, and so I think it's much more of an and than it is an or. In a world of infinite network bandwidth, I think you'd go completely to a web model in the long run. We won't be there for a while. There's a lot of smart people working on that, or working on much higher levels of bandwidth. There's actually, big efforts underway at the FCC, to release a lot more bandwidth into the wild, to solve some of this. So we'll see what, over 5 or 10 years, I think the situation will change a lot on the bandwidth front. But for now, at least, I think they'll really coexist. And we see companies doing both. We see variations on everything. We see companies building apps that contain browsers.
Right.
We see companies building browser-based apps that basically look like their desktop apps, because they're advanced users of HTML5. And it's kind of just an implementation detail.
And you're bullish on HTML5?
Yeah. Oh, of course. Yeah.
Uh-huh.
Yeah.
So let me turn now to questions from the audience. What we'd like to do, that we have some on Twitter, which will be queued up momentarily, but also we have microphones moving around. So there's one in the back, et cetera. So let's start here. I see a question up here in the front, please. Please identify yourself.
Lori Fina, we met when you were starting Mosaic.
Oh, hi.
In any case, and I was at the Electronic Frontier Foundation.
Oh, great.
So you mentioned that we have an interesting disconnect between broadband speeds. It just was released that Akamai said that last quarter versus this quarter, speeds are 14% down globally. And yet we have an incredible increase in smartphones. But the thing that we talk about, or we don't talk about, is the lack of storage on smartphones and the dependence on centralized clouds for delivering apps. And the storage becomes the limiting factor, or the broadband is exercised a great deal because of the lack of storage at the point where people are using the apps. What are your thoughts on storage as one of the third components here?
Yeah, I mean, look, I think that these are very powerful computers, and so I think that they're going to end up with a lot of storage. I think the value of a lot of the apps, though, is in the connectivity to the network. I mean, I think it goes back to kind of what I said before about things like Foursquare and Twitter and all these things. Is, the app is kind of the tip of the iceberg of what a lot of these things do. It's actually being connected to the world, that makes a big difference. I mean, the Wikipedia app without being able to get to Wikipedia is no fun. The Twitter app without being able to get to Twitter is no fun. And so, the network connectivity, the smartphone without the network connectivity is not very interesting. And so clearly, I think you need the network and the phone to evolve in parallel.
Terrific. I'll take another question over here, please.
Yeah, hello. My name is Joshua Rockoff. I helped invent Magento.
Oh, great.
Just a question on an open source to a for-profit model. You obviously started with Mozilla Netscape and successfully migrated that to a for-profit model. How did you maintain that openness and community aspect of it while still making money off of it?
Mm-hmm. Well, there's the old days and then there's the new days. So in the old days, you tried to come up with a split business model. This is sort of the open source business model where so we basically had, for example, in the early days of the browser, with both Mosaic and Netscape, we had split licenses, right? So you had academic, nonprofit, and sort of individual users could use something for free, and then businesses had to pay. And MySQL tried a different variation of that model, and Red Hat tried a different variation of that model. These days, things have changed a lot, right? The modern browser business model is the browser's free, and it's paid for by primarily by search subsidies. And so, like the Firefox, as an example, actually makes quite a bit of revenue, and it comes in through a revenue share agreement with Google on search traffic. And so these days, as you have more and more of these kind of network-based businesses, there's more and more revenue streams that come from being able to basically refer referral businesses. And so I think the business models, it actually goes exactly what we're talking about with the network, the apps on the network. It's actually not just charging the user for money, it's what is the user doing, and then what other businesses want to basically get in the middle of that in some way. And so the business model creativity that we're seeing now is a lot more advanced than what we used to have.
We have a question coming in from Twitter, which is carries on that about the carriers' business models. Obviously, with fixed line, the carriers are pretty much the dumb pipe. We don't look to Comcast for our app stores. With wireless, they still want value-added services, and their own business model is still built around more than simple transmission. How do you think this is going to evolve?
I think that's changed a great deal already in the last few years. I mean, it used to be. Look, I mean, the Valley is littered with the corpses of mobile software startups. Basically between 1995 and basically 2006 or 2007. So it used to be if you wanted to start a new mobile app company, it used to be the very first thing you had to do was go to carrier and see if you could cut the deal that would get you on the deck. Right. The term
right.
the deck.
Oh God, yes.
Right. The deck was to get you on the default screen on the Motorola StarTAC or whatever the phone was at the time. And that was after you had figured out how to use Brew or Java or whatever to build a local app, and you had tried to figure out all the phone compatibility issues and just the complete nightmare of what you had to deal with. You had to deal with the carrier, and then you had to give up 40% of your company. You had to spend a year and a half negotiating that or whatever it was. These days, I mean, it's already so different, right? Because both with iPhone and with Android, the App Store is provided by Apple or Google, right? Not by the carrier. In most cases, you can run whatever app you want on it. As the developer of the app, you don't need to get permission from the carriers. And so I actually think that change has already happened.
So you think they are dumb pipes?
Well, I don't know if they say dumb pipes. I think they have a lot of opportunity to do all kinds of things in the network that are going to be very interesting. I think there's opportunities to add value. But I think that the sort of chokehold that used to exist, that for a long time choked off innovation, I think that's gone.
Would you say that the sort of Comcast fixed line experience is predicative of how it's going to play in?
Well, even that's evolving, and so Comcast is an example. So Comcast is developing this thing, this new thing, Xfinity TV Everywhere, right? So they're actually developing this thing where basically they're actually decoupling their software from the network, and they're making it possible to receive all the Comcast programming and all the value-added services like pay TV and all the e-commerce things they're doing and everything on any device. Right, and so they're already like jumping into the new world. Actually, Comcast in particular is jumping in with both feet. And so I think it's changing. It's changing very fast now. There was a very long time where this was a very big issue. I think that's really changed.
Good. Let me take another question from the audience. In the back, please.
Yeah, hello. My name is Aaron Landy. I actually have a question for Chris Andreessen. Sorry about that, Mark. Yeah, so Chris, I was actually wondering where the spectrum of the magazine publishing industry is going. I mean, everything is turning graphical right now, but like as news is like getting bigger on the internet with news.me and Alt Top by Guy Kawasaki, I was wondering where you see like the actual print magazines going.
I'll be brief. So magazines obviously are different than newspapers and beyond. They tend to be periodicals. Obviously, the tablet has been the real game changer. We'll talk more about this actually later today with Shantanu Narayan from Adobe. But the tablet has been the first media platform that came with an e-commerce engine attached. One of the big problems with paid media is that in the early days, there was no easy way to pay for media. Even if people wanted to, they couldn't do it. The notion of the iPad and other tablets having that sort of built-in relationship, billing relationship with Apple or Google makes it a one-click experience that takes a lot of the friction out of the choice of buying. Plus, it's a rich medium, and so it's clearly differentiated from the web, and therefore you can argue is worth paying for. So I think the future is this thing, and 3 years into it, so far so good. Are you investing in tablet media in any way?
Not yet. It's a little bit outside of our zone. I will say I agree with you on one thing, which is one of the big mistakes. I've talked about this. One of the big mistakes. One of the things I wish we could go back in time and fix is we should have built payments into the browser.
Yeah.
If we had built payments, the counterfactual alternate history I like playing with is what if payments had been built in the browser, one-click payments from the very beginning, starting in '92.
Who would have owned that?
What's that?
Who would have owned that? Would you have been a bank?
Well, that was actually the big part of the problem. Is it was actually essentially impossible to do because there was no the credit card companies had. We tried. We went out and talked to the credit card companies, the banks. It was impossible at that point, I think, to work our way. We actually weren't able to do it. Also, Microsoft wasn't able to do it, which tells you how hard it was because we both tried. So it was very difficult. It actually took PayPal in a lot of ways to kind of open everything up, but that happened years later. But I think the web, it's very interesting, right? The web would have turned out very differently. In some ways, I think much better, because you would have had, for example, you would have had business models evolve maybe in a much healthier way in a lot of cases for a lot of industries. On the other hand, maybe you would have lost a lot. Maybe you would have lost a lot of the free content and free services and all the free, ad-based business models that people have come up with. So it's hard to say, but
indeed, and
I would like to try that experiment over again someday.
Well, there's a huge amount of innovation, as you know, going on in transactions with Square and beyond, and mobile payments, et cetera. Are you focusing on that?
Yeah, that's something. Well, number one, I mean, I'm on the eBay board, so we're working on that very hard with PayPal, so that's one. And then two, it's getting very interesting to see what the new business models. You make payments really easy. I've always been a believer that it's not so much that people don't want to pay for things like content, for example. It's that if it's complicated, then they just like if it's easier not to, then they won't.
Exactly.
And so much of this has to do with convenience and one click. I think people generally will pay for things that they find interesting, valuable, entertaining. And I think we're going to start, we're now able to run that experiment in a different way now that we're getting payments built more into the tablets, the phones, into PayPal, or PayPal being built into more things, Square, so forth.
So it's more about the ease and psychology of payment rather than the price itself.
Yeah, so much more. Like I've always thought the privacy problem, the piracy problem was always overblown.
Yeah.
It's not that, there's 300 million people who want to go pirate content and like commit crimes. It's that if you don't let me get my digital content in a way that's easy to get, I'm going to go find a way to get it. And I think, the media industry is now adjusting. I mean, Hulu's been, I think, a pretty big success, and as an example of like it can actually be done right.
Yeah, we have one more question, which I'll take from the Twitter audience. This actually builds on something we talked about in our Q&A in the magazine, which is Silicon Valley are there alternatives to Silicon Valley as a global innovation center, and you have this concept of where are the campuses? You use this expression, the big campuses. Can you talk a little bit about you're based in Silicon Valley? Most of your investments are local. Everyone wants to be a Silicon Valley, can they?
I would love for there to be 20 or 100 or 1,000 Silicon Valleys. I think it would be tremendous. I'd much rather live in the world in which that was the case. I think the formula is actually fairly straightforward, and I think it seems to be, for some reason, it's hard to replicate. So, right, you need outstanding research universities, right, which there just aren't that many in the world, and a lot of them are in the US. And we just need more of those all over the world. You need the graduates out of those research universities entering a culture and an environment where risk-taking and starting companies is an accepted thing to do. I mean, in the Valley, it's encouraged. Everywhere else, it's either accepted or frowned upon. And so you need a much more risk-oriented culture than exists in a lot of places, both elsewhere in this country and in the world. Then you need liquid and deep capital markets. You need well-functioning capital markets because you do have to actually fund these things, and so you actually do need venture capital, and you actually do need the stock market and things like that, and non-corrupt banking systems. And then you need rule of law. You need contract law. You need the ability to actually sign a contract with somebody and actually not have them just steal all your money a year later. And it is shocking how few places on the planet are able to combine all four of those things. And I don't want to dump on any particular country, but it's very hard to go around the world and find any place other than the U.S., any place other than Silicon Valley that combines all four of those things. And the big cultural question, I think, of our time is going to be, which countries, which cities, which cultures, which societies are going to be willing to really put this formula together to try to do this and try to do it right.
We're here in New York.
Yeah, and New York is a great, the risk-taking culture in New York is way advanced, I think, in the last 20 years. I think it's very promising what's happening in New York. There's still a problem with the research universities. The new Cornell campus, unfortunately, it's going to take 20 years to build that. That will be a huge advance, because Columbia and NYC, New York University are great universities, but they're not large-scale research universities like Stanford or Berkeley. Hopefully, Cornell will fill that in. So you're definitely starting to see the phenomenon. But it just, my attitude is sort of the throttle needs to be kept forward on all four of those factors to actually have the result be the kind of catalytic effect that we see in the Valley.
And you're finding your own investments increasingly turning to New York, or no?
I would say we're roughly 80, well, we're a single office firm, so we think venture capital is a boutique business, not a scale business, and so we're a single office firm in Menlo Park, so we're definitely biased, or provincial, if you will. We're maybe 80% invested in the US, and then within that 80% of that in the Valley is roughly the breakdown. So we'll go outside the Valley for extraordinary companies. The challenge with going out in venture capital, going outside the Valley, is it's hard to find the places where there's 10 things. It's easy to find the place where there's, you can go to Ottawa and there's one. You can go to Seattle and there's 2 or 3. You can go to Salt Lake City and there's 2 or 3. But it's hard to find the place where there's 10, 100, 1,000 of these sort of really vital young businesses with the level of creativity that we look for. New York is starting to be one of those places, and I think it's very encouraging what's been happening here. And we're increasingly active here.
So when Andreessen Horowitz opens its satellite office in New York, we know that the time will have come.
That's right.
Please join me in thanking Marc Andreessen.
Great. Thank you, everybody.